Most people think rich investors are just lucky gamblers with bigger pockets. They imagine private jets, champagne, and someone yelling, "Buy, sell," into a gold-plated phone. But here's the truth. The wealthiest investors in the world play an entirely different game than you do, and the rules they follow aren't in your basic How to Invest guide. Today, we're going to pull back the curtain and reveal exactly how the rich invest in the stock market. Strategies they don't always talk about, but quietly use to grow their wealth year after year. They think in decades, not days. The average investor gets caught in daily stock price fluctuations. A bad headline, and they panic sell. A good earnings report, and they jump in. Rich investors don't care about the noise. They follow time arbitrage, the idea that markets reward patience. Warren Buffett often says his favorite holding period is forever. And that's not a cute quote. It's a competitive edge. They buy companies, not tickers. They study the business model, the leadership, and the long-term market trends. If the company is solid, they hold, even through recessions, because they know real wealth is built by letting compounding do the work. They use money that isn't theirs. One of the best-kept secrets? Wealthy investors leverage other people's money. While most retail investors stick to cash, rich investors use margin loans, lines of credit, or structured financing. They can borrow against their existing assets at low interest rates and reinvest into opportunities without ever having to sell. Why? Because selling can trigger taxes, while borrowing allows them to keep their stocks compounding in the background. This is how billionaires live off their investments without technically realizing gains. It's a legal tax minimization strategy that the average person doesn't even think about. They buy when others are afraid. When the market crashes, the average investor retreats to cash. Rich investors see it as a clearance sale. They know that the biggest returns often come from buying during times of fear, when everyone else is selling. This isn't luck, it's preparation. They keep liquidity reserves ready, so when the market drops, they can scoop up quality companies at a discount. This is why the 2008 crisis, the 2020 crash, and other downturns ended up making rich investors even richer. They didn't panic, they went shopping. They focus on cash flow, not just price growth. While most people are chasing quick price jumps, rich investors pay attention to dividends and income streams. They invest in dividend aristocrats, companies that have increased payouts for decades, or use covered call strategies to generate income. This gives them a steady cash flow regardless of market swings, which they can reinvest into more assets. It's a snowball effect. Cash flow buys more assets, which create more cash flow. They use information differently. Rich investors don't rely on sensational headlines or TikTok stock tips. They have research teams, private analysts, and insider-level market data, legally of course. They're reading quarterly reports, attending shareholder meetings, and speaking directly with company management. They're not reacting to the news, they're anticipating it. So the next time you think the stock market is just about luck or timing the market, remember, the wealthy aren't guessing. They're following a set of rules that most people ignore. They invest for decades, leverage other people's money, buy when everyone else is afraid, focus on cash flow, and use information the right way. And here's the takeaway. You don't need millions to start thinking like them. Even with a small portfolio, you can adopt their patience, discipline, and mindset. And over time, those habits can be worth more than any hot stock tip. The stock market isn't just a place to gamble, it's a place to grow your future. And the sooner you start playing the game like the rich, the sooner you stop playing the game like everyone else.